Sam here, and I'll be doing the premium video for April 4th, 2025. So another week is in the books. We got about 3 minutes to go here before the market actually closes, but I don't expect too much to change that will change what we're going to cover in the video. So last week I tried to make a point to show you a monthly signal that I was seeing in the markets. It was a very clean monthly sell signal that we have not seen for at least 2 years. I try to also kind of combine that monthly sell signal with the bigger picture signal that I've been sharing with you guys, which is the yield curve trigger that triggered on December of last year. So just 3-4 months ago it triggered, right? So the signal triggered in December. The sell index signal triggered at the last week of March, and here we are in April, and markets are very much tumbling pretty much faster than we have seen in basically since COVID. So what has changed? Well, the thing is not really all that much. Let's dive into the charts here, and then we'll cover things as we need to cover them. So over here on the weekly chart, you have lost a lot of the structure of the chart, certainly. The chart is giving itself a neutral score, but when it's neutral, you can always look inside and see what the kind of the leading score is. And on the daily, this is the first time that it's been a bear plus, meaning that it's, very, very bearish. And a bear plus also implies that we should only be looking to sell bounces here. Now, of course, we are so far away from any kind of reasonable level to sell against, even something like this gap or any of these gaps really. Heck, even, this is a moving average I never expected to talk to you guys about, but this is the 400-day simple moving average. And even that's $22 higher than where we are now, right? So we'd have to get some pretty hefty bounces here, but the overall structure of the chart basically is now fully broken. The signal that I had shown you was right here, which is you had up arrows right there, basically at the end of 2023. Very clean signal. You can see it for yourself. Very clean signal alignment there. This is the most important indicator on the charts. And you can see that it stays correctly positioned for the entire rally, even during this pretty steep drop here, and this relatively steep drop there, and you had a steep drop here. You see how the indicator did not react at all to that, but it did start reacting to this drop here, and then of course, here we are. So the thing is, I don't actually have any like magic levels that I can give you. I think that the market is going back to 480 at the minimum. I'm looking somewhere between 480 to about 465, which is going to be the previous breakout level. And again, if you want to see it from a bigger perspective, you can go catch last week's video where we talked about 480 being kind of the scene of the crime, if you will. So it broke out from 480 and ran significantly, so it would make sense to see 480 again. However, well, here's the thing. If it gets down to 480, I think pretty much, let's say it gets to 480 on Monday, which is not that unreasonable. I think it would be a buy, right? The thing is, at this point, we're playing a different game than we've been playing, right? We've all gotten very used to playing this game, right? You buy the pullback to the 21, and it just kind of goes up in perpetuity, and it's very direct and straightforward. This time, this is a little bit of a different game, right? Now, this time, you're getting a trend reversal on the larger time frames, certainly. So the weekly chart has taken severe damage, which we haven't seen in years. The daily chart has taken severe damage, which we haven't seen in years. However, you also have like this really ridiculously extended market to the downside. The problem with that is that we didn't get here without a catalyst, right? The catalyst was the tariffs being significantly punchier than expected. And I don't think that we can get out of this without a catalyst. So what does that mean? Well, I think we either A, need to see, realistically, I don't see the Fed intervening here, right? So I was going to say maybe we could see an emergency Fed meeting and an emergency cut because they won't meet again until May. So that is a possibility. Seems unlikely. A secondary higher probability would be something like a positive news on the tariffs this weekend. Maybe a handful of countries step up and decide to play ball and take down their tariffs. We take down our tariffs, and we get a relief rally on Monday. But for those of you that were trading in 2007, 2008, you recognize this price action, and the price action is one that will basically push the market to its limit to get what it wants. Back in the day in 2008, the market wanted a bailout, right? And if you recall, the government went back and forth. Do we really want to bail you out? Do we not want to bail you out? And as the government officials went back and forth on that, the markets just tanked and tanked and tanked. And eventually they capitulated and bailed them out, and that was pretty close to the bottom. Although they didn't bottom until March 2009. This is something similar where the market seems to want an end to the tariffs, or at least maybe a middle ground on the tariffs. And so, the possibility that we can get down into this zone next week is extraordinarily high. I wouldn't normally say that, but here we are. So I don't really have too much here in terms of things to cover with you because we are in a weird spot at this point, right? I think if you watched last week's video, and frankly, if you've been watching any of my videos that I've been providing for you since December, kind of warning you about this, hopefully you've at least taken precaution in your longer term accounts. In terms of trading it, let's kind of take a look inside this thing. Actually, before we do that, let me show you this. So if you go back and watch last week's video, I showed you kind of a monthly turn signal that we haven't seen in multiple years. It's a very clean signal. It's hard to deny it because it's so clean. There has not been a lot of noise in that signal, and it has triggered officially since the end of March. And the signal implies that we're somewhere in this neighborhood, right? We've already kind of hit the inflection point, but we haven't actually really taken the severe drop, which would be implied by the broader signal, right? I think that if 480 ends up not holding on SPY, then we're talking about a different animal here. So I think we're right here with the circle, right? Where the circle is, I think that's where we are currently. However, I want you to be very aware of this because although this is the time frame that I see clearly, you have these like smaller time frames inside of it, right? So you can see how like the monthly is like this big circle, and inside of that you have like little weekly circles, and inside of those you have little daily circles. So, could we be somewhere in the neighborhood of like where we're breaching to the downside here on the monthly chart? Like let's say that we're here currently, right? Somewhere in this neighborhood. In my opinion, we still have a long way to go. But could we be somewhere, maybe here in terms of the daily chart and about to turn back up before we go back down later? And that's really what we have to leave room for, right? Now, I'm not saying that that's the case. I think that if this weekend happens and there's no positive movement on the tariff stuff, then I think Monday opens and we see more of what we're seeing today, right? I think the market will continue to throw a massive tantrum, make itself known, put itself on the news, and make itself a topic of conversation until it gets what it wants. But let's also kind of keep in mind that if any of that happens, we could be in one of these cycles here, and then we can get a very large counter trend bear market bounce in the context of a falling monthly, right? So if Monday comes around and we have a huge bounce, let's say it's a 4% bounce in the indexes, let's just get nuts with it, that really won't change anything, right? The damage is now so far into the charts that the monthly is now the cycle, and if we start to go into a daily up cycle like this, it does not negate the fact that, in my opinion, we're in a very strong down monthly cycle that has not yet completed. So a little bit of kind of context there. Let's go ahead and move on to the Qs, and we'll try to do the rest of this pretty quickly. So the Qs almost went limit down. Haven't seen that in a while. So Qs are the exact same thing from a score perspective. So I'm just going to keep it moving because everything we just talked about on SPY basically applies to the Qs. I actually don't think that there's all that much nuance in this market at the moment, right? I think you'd be kind of hard pressed to find nuance at all. So if you look here, I loaded this up for us, this is the sector ETFs. And so right now the SPY has a negative 36. This is a negative 36 out of 50. XLB has a negative 50. XLC, which had been a standout, is a negative 36 now, right? So are any of these better than the market? Well, financials is the same. Industrials is the same. XLK is worse. Utilities is the same. Kind of surprising. Even utilities are getting sold pretty hard. XLV, healthcare is worse. XLY, discretionary is worse. Semiconductors are worse. The only thing really that's better here is two things. One is staples, and the other one is energy. Now, energy, even though it is technically the best sector here based on just the raw scores, I'm actually going to go ahead and cross that off because I don't trust oil, the commodity itself. So I think this is kind of a phantom score, and once the real break in oil starts to happen, this will just go deeper into the red. So out of all of these sectors, they're all pretty much worse than SPY, except for staples, which unto itself is not actually a particularly high score, right? Where this is just the cleanest shirt in a pile of dirty laundry. So not really anywhere to hide either, right? Normally, if in a normal pullback, you'd have like selling in the XLK, you'd have some selling in maybe some semis, some discretionary might get sold, communications might get sold a little bit, but you'd have like buying in the staples, you'd have some buying in utilities, you'd have some buying maybe in healthcare. Folks would start to rotate into more defensive positions, but this is just them throwing everything overboard. So there's not really anywhere to particularly run to. And it's also kind of this catch-22 because let's say on Monday the market is going to be up pretty strong. Let's just hypothetically say that we get like some positive tariff news. Monday starts strong. Do you really want to be in the staples, right? In that instance, if the indexes are strong, you probably want to be in the stuff that's been beaten up. So you probably want to go back into tech if that's the case. So for now, staples are the best thing on the board. It's the one thing that I do trust a little bit more than anything else, but I also acknowledge that in a very strong market, staples actually won't necessarily be the place to be. So let's go back over here to the IWM, and IWM here has just got absolutely wrecked. Very clean double top, and with this type of pattern here on IWM, there's almost no particular reason it won't just go back to the bottom of the range, right? You have a top here, you have a top here, you have a very clean and very long protracted base there right around 165-ish, and you can see that there's still room to go into that low. I don't particularly see a reason other than just it's beaten to what, and maybe gets an oversold bounce, which changes nothing. This would have to get back above it'd have to get back above like 200 to restabilize the chart. So any bounce here, in my opinion, is just an insta sell. But overall, when you have this pattern here of a flat top here, flat double bottom, or flat double top, I should say, and you have a very clean kind of long base underneath it, everything that kind of happens in between is just, whatever. And then when you have a move like this, you typically should go down to the bottom of the range. So this would imply that there's probably another 20-ish bucks left in the IWM to the downside, which is about 1/9, so about 10% or so. 10% to the downside here would be the implication if IWM were to get back down to these lows. Let's kind of keep moving though, because I'm looking for reasons to change my mind, and I'm frankly not seeing them, and I don't think we will see them, right? I think that the die has been cast here. So when you have a blanket of red across all markets, it makes things very much binary. So this is something that we've been following as well together. This is HYG, and notice how bonds, well, let me say it this way. Interest rates went way down, right? Out of fear, not for good reasons. Interest rates went way down. Normally, interest rates going lower is good for HYG, but it's not good if the reason that interest rates are going lower is out of fear. So the way that you can tell is if you have, let's say you have I'll just give you an easy one. If you have TLT deep green, right, TLT way up, and HYG is red, that means that folks are going into bonds out of fear. If you have TLT green, especially deep green, and you have HYG also green, that is a positive. Whereas TLT green, HYG deep red is very much a negative. So here, I mean, you just kind of shattered the chart, right? You've completely blown out the bottom of the chart. This is a massive move in HYG, and basically it starts to set up a credit event. That was always in the cards, you know, back when I used to talk to you guys about the signal that I was seeing based on the yield curve, which triggered in December. I would describe it as a credit event. Very similar, and all credit events are the same, right? It doesn't really matter what the catalyst is. In this case, you know, the catalyst will be pointed at the tariff guy doing tariff guy things. But at the end of the day, it ends up being a credit event, and it's very similar to COVID, and then certainly before that, very similar to 2007, 2008, in my opinion. So all credit events end the same way, and that is with mass liquidations of everything. And to prove my point, let me show you gold here. So even gold, the mighty gold, got sold today. And I think that might have been a top for gold for now. I don't have a reason to believe otherwise. With gold, be very aware of this, that if we are going to see a credit event type of situation from this, and also mind you that when I say this, I'm implying that this is still very early. It's happening extraordinarily fast. I mean, in the last 2 days, it's happened very, very fast. But in my estimation, if 480 does not hold on SPY, then we're going to go back to a 3 handle, right? Like this is really could get really bad. Like the signal, there's a reason that I try to stress to you guys so much that signal that I was seeing, because once it triggers, you won't have time to buy protection, right? It's like you want to be aware of the hurricane before the hurricane hits, because if you wait, you won't be able to afford an umbrella. And so if you buy any of that, and if we're working under the assumption that this could lead into a credit event, then basically gold also is not a safe haven. So I just want to make sure to clarify that with you guys very, very clearly. I think it's a little cute here to short gold. I'm actually tempted to, because I have some early signals to do it, but I think that's a little cute. But at the very least, I do want you to know that gold is not a safe haven in a credit event type of situation. And again, never take my word for anything I tell you. Go make sure that you prove it to yourself so that you can see it with your own eyes, through your own prism, using your own indicators. And the way that you would do that is by going back to 2007, 2008, and just look at what gold did then. And you'll be able to see very clearly that gold will not be a safe haven, because it will be sold to finance margin calls, is usually what happens. Because we're talking about gold, let's talk about digital gold here. So let's see what Mr. Bitcoin is doing. Now, this is a bit of a surprise to me. I do have to admit this is a bit of a surprise to see Bitcoin green, and very decently green, on such a bad day for equities. Normally Bitcoin tracks with the NASDAQ pretty closely. So could we be seeing a decoupling here? This is probably the one interesting thing that's like not Captain Obvious for this video, right? Because telling you that things look bad now that things look bad is kind of redundant. Hopefully you took action in your longer term portfolios based on the signals that I had been showing you before things got bad. Now it's a little bit redundant. So what we're seeing is somewhat obvious in the indexes and sectors, but what's not obvious is what's Bitcoin doing here. Why is it green as a risk asset when risk assets are being thrown overboard? So I think going into next week, we're going to have to start paying maybe a little bit closer attention here, because in the event that Bitcoin could potentially be decoupling from other risk assets, it does make it somewhat interesting, right? And this, if nothing else, this should be the time that Bitcoin, at least theoretically, this is what it was made for, right? It was made for a distrust of a dollar-based system, essentially. Now, we haven't seen it behave that way, so I want to be really clear about this. We've seen Bitcoin basically just trade as levered NASDAQ. So basically, Bitcoin has been traded like the TQQQ. Today is a notable exception to that. So one thing that I will be looking for here on Bitcoin that would get me interested in it would be if you can get a squeeze histogram turn. So you see how your squeeze histogram is red and pointing down? If you can get that to hook higher with a yellow bar, very similar to this, then I would become very interested in Bitcoin again. It's a little early to say it's fully decoupled, but today is a striking irregularity based on how Bitcoin normally behaves. Lastly, let's go to the VIX here. So VIX of 45 is certainly proper. Some would say that is a proper VIX. I do want to draw your attention to one thing for what it's worth, because this is a signal I've been looking at for a while now. And this also, to me, implies that this is going to be longer lasting than I think most people expect. Most people, I think, are expecting a blip. Maybe they're right. I just don't see the evidence of that quite just yet. What I'm seeing here is that VIX on a monthly time frame gave you a sell signal in 2021. It gave you a sell signal 4 years ago, right? And for 4 years, it stayed in a sell signal, even through here, even through this giant pop that happened right there, that actually got us higher on the VIX than where we are currently, by the way. Notice how it did this gigantic pop. This was Japan and the yen carry trade. Notice how it did not register on the lower indicator. Now, it has definitely registered on the lower indicator. So now what do you have? Well, you actually have a really bullish looking monthly VIX chart. Ignore all of that, although you probably shouldn't, but let's just ignore that for now. And I want you to pay attention to the squeeze histogram here. Notice how the squeeze histogram does not look at all exhausted, meaning that it has gone from what looks like a frown, or excuse me, looks like a smile, right? Because it has like this bowl kind of shape to it, call it a smile. And then normally when it would go up, it's going to go, and eventually it'll go up through the midline, start printing positive values, and hook lower, kind of like that right there. So the smile, which is what it's currently in, has not yet turned into a frown, which is what you want to see. So it's kind of backwards. In this case, smile on VIX is actually going to make you not smile in real life. and a frown on VIX is going to be a buying opportunity, in my opinion. So I wanted to show you this. I actually did not expect to see this. I hadn't looked at it today. I was just really, my intention to show you the VIX was just to show you the squeeze histogram is so close to firing and has not yet even gone through zero. So be extraordinarily careful with thinking that you have called the low, right? There will be very convincing bounces in this market. When you have falling markets, you can get some of the biggest bounces pretty much on record when you have bad markets like this, right? So if Monday's up 4%, and then Tuesday, we get good news over the weekend. Monday's up 4%, Tuesday's up 2.5%. Wednesday's up 2% again. Let's keep things in context and keep that bigger picture that I shared with you in the back of your mind, right? So it doesn't mean you can't trade it to the long side, certainly. Ideally, I think it'd be kind of a meaty long if we could get some positive news going into Monday. But at the same time, I think it's important to have a North Star in this market. And I think the North Star, the best North Star that I could offer you was given to you last week in the form of the monthly sell signal. And here I am kind of backing that up again, this time with a monthly buy signal on the VIX. So this could go on for a lot longer than most people think. Again, as traders, hopefully you're well positioned for this. Hopefully this isn't making you want to rip your hair out. This is probably not going to be a great time for an extended amount of swing trading to the long side. I think that this is going to be the year that you have to be able to sharpen your day trading blade and really focus in. And one thing that I'll leave you with here is a sign on my desk that I certainly could have done a better job of following myself. But as always with you guys, I like to kind of drop the kimono a little bit and show you what I'm packing underneath. And the sign says fully focused or fully flat. Fully focused or fully flat. So jot that down, maybe put it on your own desk and ask yourself in every moment that you're trading, am I fully focused right now? And if you find that you're not fully focused, let's say you're having some health stuff, you're having some family stuff, anything that might be distracting you from the moment, then just go fully flat, right? Just be able to do that. And if you're not fully focused, you should be fully flat. And I think that is one of the best things that I can offer you guys into a turbulent time, because if you are going to be fully focused, then guess what? A VIX at 45, that's a ton of opportunity, right? As traders, we shouldn't necessarily care whether the market goes up, down, or sideways. As long as it moves, that's what we want. That's why we show up. And there should be plenty of movement with a VIX with a VIX at 45. So hopefully all of this was helpful to you. If you didn't catch last week's video, go back and catch it, because I think it ties together very nicely with this week as well. And it also is a little bit of a kind of a leading indicator, if nothing else, into this week. And we'll see what happens over the weekend. Again, if there's any positive news, you will get a very large squeeze. It might be a very convincing squeeze. It might even last a couple of days. Hell, it might last a week. But I would just be cautious, because based on the longer term signals that I'm seeing, this has a little bit longer staying power than I think most people anticipate. So trade accordingly. All right, guys, that's my time. If you're watching us on the YouTube, leave us a like, leave us a comment if you have any questions, and I will catch up with you guys next Friday. Cheers.